I am delighted to be here again. My goodness gracious, I'm certainly dating myself, 44 years. I want to talk for a minute about this. I left this up here. Mike, I'm going to give this to you. This Social Security horror stories is a work of the heart more than anything else. We have heard from my little old ladies and disabled people, millions of them literally, more than 2 million Americans, whose Social Security belatedly and without any facts has decided that they made mistakes, some as long as 40 years ago when these people were children collecting disability benefits because of a disabled parent. And Social Security has reached out to claw back money. The most recent letter was 2 nights ago. A Chicago woman, 68 years old, was going to have knee surgery next week. Many years ago, she had some short time on disability. When you stop the benefits, because that's what they do, send us $38,000, $75,000, or we will stop your benefits. She called me. They said, they're stopping my benefits next month. I pay my Medicare premium. I live on Social Security. I'm happy to report that the Treasury Secretary has taken a personal interest in this story, and Larry and I have also been in contact with the House Ways and Means Committee. We're not letting this go. Social Security not only made horrendous mistakes, if they did, they won't justify it, but in addition to that, they have been bullying people who are old, disabled, and unable to get through to them. We're not going to let that stand. So if you have a chance to write to Congress, please do. You can sort of tell my heart's in that one. Okay, well, another year has passed, and as we leave 2023 in the dust, let's take a quick look back at not only the numbers, but the kind of economic forces that changed since we last met. You know, what stands out to me among all that's gone on in this last year is that when we met last year, Dr. Bob introduced a concept that was brand new to 99% of us. Nobody really at that point had heard the term chat GPI. Oh good, there you are. I knew you were sitting down there. In the last 12 months, this whole concept of artificial intelligence has developed the power to change everything, for better or for worse. The stock market, of course, reacted, valuing the companies that are involved in it very highly. And it will now confront us all in our daily lives, whether we're searching on our computers or helping our kids with their term papers. That just got easier. The real question in my mind is, has artificial intelligence become more dangerous than natural stupidity? We see plenty of both. This has been an unusual year also, a year in which the stock market cheered losses. Well, losses of weight, that is, brought on by life-changing drugs Ozempic and Wegovy. And it's a year when the markets feared losses. It's hard to remember back to spring, it's almost a year ago, when the Silicon Valley Bank threatened to bring down small and mid-sized banks merely for having invested in a mismatched batch of Treasury assets. But somehow the recession, widely predicted for last year, failed to appear. And unbelievably to some, the year 2023 ended with the stock market literally bumping up against its all-time highs despite 2 threatening wars and continued political dysfunction. So as our tradition, I'm going to be showing you the graphics of where we were last year and not where we stand this year. Nobody has a real crystal ball, but the fact is we all rely on these forecasts because they help us make important decisions in our personal lives. How to invest your 401k, perhaps, is it time to get a mortgage now that the rates have started to drop? Or for all of you very sophisticated business executives, what about your expansion plans that impact not only your bottom line, but the lives of so many of your employees? So let's take a look and remember that this year, of course, also is the year of a presidential election. One personal thought before we start. I put these graphics together always the day before to keep them up to date. And you mentioned, thank you, Mike, my 44 years, so I decided to go back and look at the long-term Dow Jones Industrial Chart, and back on January 2nd, 1981, the Dow was 972.78. I didn't miss a digit there, 972. In my investing lifetime, the Dow was below 1,000. So it just proves to me that Warren Buffett was right. Despite all the ups and downs of the stock market and the economy in those last 44, 45 years, despite recessions and inflationary periods and financial crises, despite the Fed's activity and the politicians' insanity, Warren Buffett was right. No one ever got rich betting against America. So with that, let's take a look at some charts that show us kind of perhaps a one-year view. Okay, we have the Dow Jones Industrial Average. When we met here last year, the Dow was 33,973, about 100. And today, when we, by the way, we always use the dates of our meeting. So actually yesterday, the Dow closed at 37,683. It's down another 150 or so right now, but about 100 points from its all-time high last night. In fact, for 2023, the Dow closed up 13%. Now, you remember last year, and I'm glad they showed that little clip. Nobody wanted to forecast last year. We had very few bulls, but I gave you a broad middle section. So this year, let me make it a little easier for you. I'm going to ask for a show of hands. Now, you just have to have an opinion. Let's say we're currently around 37,700. Will the Dow close a year higher or lower? How many people think the Dow will close a year higher? Let's see your hands. All right, all right. How many think the Dow will close the year lower? Hands. What, nobody has an opinion? Let's do this over. I'm not going to stop. How many people think the Dow will close the year higher? Will the market be up? Good, okay, about 40, 50%. Now, how many people, don't just say by default, vote. How many people actually think the Dow will close lower? Okay, a bunch of I don't knows, but at least I'm going to write this down. At least 50% think it's higher. Okay. We should mention the S&P 500. We always use the Dow because it's what we remember, but the S&P is the professionals index, a much larger index. And in fact, while the Dow was up 13% last year, the S&P was up 24%. Last night it closed at 4763. It was dominated by tech stocks, of course, and so that's why we have that higher. And the NASDAQ. The NASDAQ, what a story it's been in recent years. Last year when we met, it was coming off its worst year since the dot-com bubble. Last year in 2022, when we met last year in 23, it was after a 33% decline in the NASDAQ. In 2023, the year just ended, it regained a lot of ground, gaining 43%, driven by gains in big technology companies, including NVIDIA, Amazon, and Microsoft. Last night it closed at 14,843. Now, interest rates. This is one we're always interested in, for sure. They impact so much of the economy. Last year at this time, the 10-year Treasury note carried a yield of 3.54%, 3.5%. It was coming off a previous year, 2022, where the 10-year Treasury lost 10% of its market value because interest rates were rising. Today, the 10-year is yielding 4.02 when I just looked. But take a look at this chart, because the peak in late 2023, the closing yield of the 10-year Treasury briefly touched 5%. And it was about that time, you may not care about treasuries unless you're buying T-bills, which are still 6-month bills at 5.25. But mortgage rates are set on the 10-year Treasury, and they were over 8% in the fall. They've dropped since to about 6.75% on a 30-year fixed. So interest rates have come off a little bit, and we'll see what our forecast is. But you know what? Let me do it again, see if I got your attention. What do you think? Will interest rates be higher? Now, we're just talking about the 10-year Treasury note. You can remember this. Call it 4% today. Will interest rates be higher? What could push it higher? Inflation, or the Fed fighting inflation, or who knows? Or what could push it lower? Oh, they beat inflation. Maybe they raised rates too much and we slide into a recession. So just raise your hands. How many people think the 10-year 4% interest rate will be higher at the end of this year? Ooh, 1, 2, 3, 4, okay. How many people believe the 10-year Treasury note rate, interest rates in general, will be lower at the end of the year? Oh, wow. Okay, a lot. Oh, okay, overwhelmingly. Let me just put this. Okay, overwhelmingly lower. I have to keep my notes, to come back. Okay, and, by the way, when we get our panelists, that was an easy one, wasn't it? I made them really easy for you this year. But the panelists, I'm going to make it tougher. I'm going to ask them how many rate cuts they expect and when the first one will be. So panelists, get ready for that. Okay. One more, inflation. Let's see if we can get that. Okay, inflation, the Consumer Price Index. Here's a quick look. This is a 20-year chart of the Consumer Price Index. You see in June 2022, over 9%. The estimate for the CPI coming out later this week is somewhere around 3.7%. The question is, will we get to the Fed's desired 2% in 2024? We'll ask our panelists in a moment. The recession, GDP, that's a chart for the last 5 quarters of gross domestic product. 2 negative quarters would be a recession. What recession? In fact, we're looking at an estimate of 2.2% positive for the 4th quarter. So let's ask our panelists, what happened to the recession? Is it still coming? And just to keep things interesting, I don't know if you could see this, but I was just bring up Bitcoin because it always stokes John. And I can't wait to hear what he says. A few years ago, he called it a tulip bulb, and then it did collapse. So take a look at where Bitcoin's been. 42,000, then in 2022, 17,000 when we met. Today, I just looked, it's about 46,800 when I looked. And the interesting question is, where will it go? It's still below the highs of 65,000 in November 2021. Okay, here's the part we're all waiting for. The forecast. So let's see what we're getting. I've asked each one of them to forecast specifically. I won't let them leave the podium till they give me a number. The Dow Jones Industrial Average, NASDAQ, the 10-year Treasury at year end, and by the way, when will the first rate cut be and how many will there be? GDP, i.e. will there be a recession in 2024? Inflation at year end. The wild card is Bitcoin. And then, of course, the most popular question of all, which is, what do you do with $100,000 in the year ahead? So let's get right to it. Thank you, panelists. Are you all ready? All right. Let me start with an introduction. All our panelists really need no introduction. Let me try and be brief. As always, I start with Diane Swonk, our longtime panelist and friend. Diane is chief economist at KPMG. She's started out as a labor economist, and her roots are in Michigan. So on behalf of Diane Swonk and myself, U of M, go blue. I could give you all Diane's honors and awards. They're in the book, so I'm going to skip right over that. But let's talk about what she said last year. Diane forecast an unchanged Dow close of 34,100 and the 10-year at 3.2% by year end, so somewhat lower than it is, and a 6-month T-bills around 5%. She had inflation dipping below 3% and a mild recession was in her cards. She thought the Fed would start to cut rates by year end, but only if inflation was firmly below 3%, so it isn't, and they didn't. As for investments, Diane would have had a very nice return and none of the risks entailed when she forecast, because she put her $100,000 into 6-month T-bills, which were yielding over 5.5%, and then said halfway through the year, which was very timely, she would lock in longer Treasury rates just before they dipped, and they did. So now let's see what Diane Swonk has to say for 2024. Diane.
So now you know why I'm an economist and not a professional investor. So I thought I'd start with a quote that really struck me this year as I was thinking about the outlook. Doubt is not pleasant, but certainty is absurd. That's from Voltaire, and it resonated as I watched financial markets rally on expectations of rate cuts by the Fed. They seem as certain that the Federal Reserve will cut aggressively and the economy will keep humming as they were a year ago that the Federal Reserve would push us into a recession. I understand the optimism. I don't understand blind faith. The economy surged, as Terry showed. It accelerated in 2023 after coming in at 0.8% on a fourth quarter to fourth quarter basis in 2022. It looks like it will exceed 2.6% on a fourth quarter to fourth quarter basis in 2023 as of today's data. More than 3 times the pace that we saw in 2022, with the most aggressive credit tightening the Federal Reserve has done since the 1980s. Inflation decelerated at its fastest pace without a recession on record. The labor market ended the year in one of the strongest places it's been since 2019, by some measures, the best it's been in decades. Unemployment, 24 consecutive months, 26 if you count the 1 month, it edged up to 4%, below the 4% threshold on unemployment, the longest span since the 1960s. Prime age participation in the labor force, which I'm no longer in, of course, 25 to 54-year-olds, hit the peak we hit after a recession for the first time this century. Prime age participation among women, led by women of color, hit a new all-time high, despite the fact that we had the she-cession, the recession that hit women harder than men as COVID shut down the economy. Women came back despite a child care crisis and a care crisis more broadly. In December, the one group that did not participate as much and dropped out of the labor force were women 55 to 64 years old, caught in between the care crisis we have in this country, between caring for grandchildren and their elderly parents. How did we beat the odds over the last year? What was thought to be the hardest mile of the Fed's marathon against inflation morphed into a relay race, with sectors that lagged handing off the baton, picking up the baton from sectors that led earlier in the expansion. Less interest rate sectors have dominated employment gains for the last 6 months, and in fact, only 3 sectors have dominated employment gains for the last 6 months: healthcare, leisure and hospitality, government at the state and local level, largely public education. Leisure and hospitality and state and local government hiring, after severe staffing shortages, finally crossed the peak hit in February of 2020, near the very end of 2023. That higher concentration of employment in those 3 sectors has also made us more susceptible to external shocks. October is a case in point. During the height of the UAW and actors' strike, private sector employment gains slowed to 44,000 in October of 2023. That's not statistically different from zero, and the weakest private sector employment we've seen since December 2020, when employment slipped back into the red again, as the economy almost slipped back into a recession after the initial reopening after lockdowns. That underscores the fragility that we face. We also saw resilience in the U.S. consumer rising up and playing atlas not only to the U.S. economy, but to the entire world, as they had locked and loaded and gotten themselves immune from rate hikes by locking into lower interest rate mortgages. The rest of the world adjusts on their mortgage rates much more frequently. They don't have 30-year locked rates. It also created what was called and is known as the mortgage winter. It locked people in the places they're in. Over 40% of households have paid off their homes entirely. And it's too unaffordable to sell and trade up in this market, and first-time buyers are frozen out, hence the mortgage winter. But that did shelter us from the worst of rate hikes. Even corporations who had financed their debt going all the way back to 2019, 2020, 2021, and early 2022. That debt is set to reset in 2024, but it was at much lower rates. The healing of both household and consumer balance sheets helped carry us through 2023 into 2024. So what is the forecast as we look forward? We're looking for what the Fed is looking for, a soft landing, but a soft landing is not the same as no landing. We're looking for growth to slow to 1.3% on a fourth quarter to fourth quarter basis. That's 1.7% year over year. That's less than the US economy's potential. What that means in layman's terms, and this is really important because a soft landing is not the same as a no landing scenario. In layman's terms, it means that profit margins are squeezed as higher rates start to take a bigger bite out of profits and consumers push back against price hikes and the ability to pass along those price hikes and keep their margins intact to consumers. Investment is hit harder than consumer spending. Hiring plans are scaled back. Unemployment rises as job openings slow and hiring slows with it, and job seekers come more in line with job openings. That's better than a surge in layoffs. That doesn't mean some sectors don't slip into recession. The freight industry, heavy truck industry is in a recession right now. As we see that go, it's a tough needle to thread to get to that soft landing because it wouldn't take much to push us through the ice. The resilience we have is certainly something very stunning and worth remembering. There's also an election. And thinking about that in terms of what it means for the economy, policy uncertainty is still extremely high. Policy uncertainty acts as a tax on the economy. It causes hesitation, particularly among large firms and their decisions to invest. Again, something that will suppress growth. That's important because with the time it takes to sign an executive order, we know policy could change as we enter the next year. That's important to factor in as well. The Fed itself is more uncertain about its outlook than financial markets. The minutes to the Federal Reserve meeting in December revealed that the Fed is more worried about the upside risk to inflation and core services inflation getting sticky. Leisure and hospitality in December, one of the reasons it increased so much was we actually saw an increase in hiring at sporting venues. I call it the Taylor Swift effect. My daughter is a huge Swiftie. And let me tell you, I have now learned that money can truly buy you happiness. I bought my daughter, and I have a huge task in front of me. I bought my daughter tickets to the November 2nd Indianapolis Taylor Swift concert. Extremely good tickets. the biggest present I've ever given her. And she was so excited. I've never seen her just show such extraordinary joy as I gave her this gift. And she turned to her fiance and she said, "We're going." And I said, "No, sweetie." I'm not going to say anything more about him. He's long Bitcoin. I'm sorry, I digress. I can't help it. You know me, my kids. I have to bring them up. Back to the Fed. The election year in the Fed. Wow, they're more uncertain about policy. The minutes to the meeting revealed that they're more worried about upside risk to inflation. Some were even discussing additional rate hikes, not rate cuts. And in fact, they came out and pushed back and said, no, we weren't really talking about rate cuts. But there was an important but subtle shift in the Fed. Actually, it was a pivotal shift by Jay Powell. And that was when he was pushed about the risk that the Fed would hold on too long and trigger a recession. He pushed back and did a 180 from what he had said the year prior, and that is that we're focused on not making that mistake. That is hopeful. Their doubt is hopeful. Their willingness to keep an open mind is hopeful. Their uncertainty, I lean into. I expect the Fed is hardwired not to respond to political pressures because one Fed chairman, the worst Fed chairman on record, Arthur Burns, did. During the Nixon White House for the re-election campaign, Arthur Burns was pressured to stimulate, and his policies in the 1970s were blamed for the stagflation that erupted. And he later created what was a Bible for central bankers called The Anguish of Central Banking, talking about the political pressures that existed and how any short-term gains in employment that occurred from easing only came back to bite us and haunt us with more inflation and higher unemployment down the road. That's why the Fed doesn't want to cut and have to reverse course and raise rates again. They need to see more evidence than the financial markets see in order to cut rates. Our first rate cut is in May, not in March. Could we get to a rate cut in March? We could, but it would take a significant slowing in the economy and inflation from where we are. The lags in policy suggest you should cut before you get to the 2% on inflation. But I think it's important to remember that the Fed is hardwired to not make the mistakes that were made during that period in the 1970s. How do we know those mistakes were made? Well, the Watergate tapes. Lordy, lordy, there are tapes. Who in their right mind would actually know on tape that they were trying to change the outcome of an election? Just a thought. That haunts the Fed to this day. It's hardwired in how they think. Chairman Powell, who was nominated by the last president and confirmed as Fed chairman, took some of the most brutal public attacks on what was formerly known as Twitter. I won't even, that X is kind of hostile, from the former president, and did not waver. He once told me, he said, it's worse on the phone. That's important. The Fed doesn't have a horse in this race. However, they will be blamed for influencing the election no matter what they do. So we have 4 rate cuts. We have a soft landing, not the same as a no landing. And I'll end where I started. Voltaire believed that doubt was something to be leaned into, that skepticism was something to be embraced, that tolerance and an open mind were important to learning and pushing the limits of human knowledge. He actually corresponded with Ben Franklin, and they believed in a lot of the same things: tolerance on religion, human rights. He lobbied against slavery. That seemed important in an election year. I'll also end on a personal note, because you know what I've been through in recent years, my battles with cancer. In the last 3 weeks, or last 3 months, I've had yet more battles to deal with, and I'm still here. So an economy that beats the odds is something I identify with personally. I have a new scar. My daughter said, I was going to cover it up, and my daughter said, Mom, wear the scar. They are your strength. I have a spot on my lung, and I just found out a week ago that instead of having to go on a 1.5 years of antibiotics and a port, for some reason the doctor cannot explain, given the size of what's on my lung, I am healing myself.
Whoa.
On that note,
Yeah, you're not escaping. Even if you have all of our love, we still want your forecast.
well,
You
I am
we've been
hoping
friends for too long.
that the
Excuse me.
economy is still standing as I will be standing here
That's
a
a
year
good
from
bet.
now.
That's a good bet. And we all hope that those, in both cases, that's true, that we're all still standing and doing better. Now, the Dow. We're about 37.
Yeah, I know. I think the markets are ahead of themselves, and if we have a soft landing, that's not good. That's a reckoning for financial markets. And that will squeeze profit margins. And that's why I was so careful to say a soft landing is different than a no landing scenario. It sounds nice. Soft.
Okay, come on, give me a number. Don't evade me.
I'm trying.
I'll tell you what, I'll make it as easy as I did for the audience. Will the market
36,900.
30 higher, okay. Or lower,
Lower.
36,900.
10-year,
A bit lower.
3.4%.
Wait. 10-year.
4 rate cuts.
3.4%.
Unemployment rate, 4.1%.
Okay, wait a minute. Okay. I won't make you do the NASDAQ. What was your number for inflation, though?
Inflation by the end of the year, we will be a little above, depends on which measure, but on the CPI, we'll be about a little north of 2%.
Oh, but we will get under 3%.
Oh, yeah.
Okay. With the soft landing, with a recession?
No recession,
No recession.
but we
Okay.
could skate on thin ice, but we've made it
Okay,
this
no
far.
recession. All right. And you never want to comment on Bitcoin. Do you want to comment on Bitcoin?
Like I said, Chris is...
Okay, we'll ask your about-to-be son-in-law next year. What do you think your son-in-law thinks Bitcoin is going to do?
He's not my son-in-law yet.
You're about to. So you're about to be, I think I said.
We're 12 years in,
Oh, all right.
since
okay.
high school.
Then let's just jump over that to the Are you going to pay for this wedding?
I've known him since he was a little kid, grew up down the street. Isn't that sweet?
You don't want his Bitcoin advice then. Okay. Now, to the critical question, $100,000.
Well, clearly, I have people that manage my money, which is how I got my husband to get me this beautiful necklace to go with my scar. So I'm giving it to John.
Oh, you took Dr. Bob's answer from last year
I give up.
to John.
I'm giving it to John.
Okay, but that means, I know John's going to be a little bullish. He always is, and he's always right. Question is, are you willing to move out of the risk area, the risk-less area, pretty much, that you took last year and got nicely rewarded with treasuries? Does that tell me that you're moving into equities for this year?
I have very good money managers. And they're in equities, and I am long equities, but I'm not long the Dow.
Not long the Dow. Okay. Well, then John's your guy. All right. Thank you very much. Diane Swonk. All right. It's a good time to say keep your questions coming because we're going to look at all of them. I'll come back up here, do an official introduction while I keep track of everything. John Rogers, what a great job you did last year. Should I use this? I'll use this, okay. What a great job you did last year. As you saw from the video we played earlier, John nailed his predictions. While everyone else last year at this time was fearing a recession, he sounded a very optimistic note. He said the bad news was baked in, and he was firmly saying we will not have a recession, and that inflation, he said, would be under control down to around the 4.25%, which looks like where we are. By the way, in case there's someone in this room who doesn't know John Rogers, he founded Ariel Capital Management, the first black-owned investment firm in the United States. This year, Ariel celebrates its 41st anniversary. Its flagship fund, the Ariel Fund, wait, there's more to applaud. There's more to applaud. The only mid-cap value fund in the U.S. today that dates back to 1986. That's called survivorship bias. John, you and I are. And I remember interviewing him back in 1986 when the fund came out. John's the longest tenured portfolio manager in Morningstar's mid-cap value category. And he's a Warren Buffett devotee, and it shows in the long-term returns of his fund. Last year, John forecast the Dow would be up over 10% and the S&P maybe even higher, and in the midst of a tech stock rebound. Well, it was higher. By the way, did I mention that Ariel was up 16% this year? Was it year over year? Yeah. So Dr. Bob, you did a good thing by giving it to John. And maybe you'll do just as well for Diane this year. Maybe, I told you I should have done that 40 years ago. Last year, John said the Fed would start cutting rates in the fall with a target of 4% for the 10-year, which is where we are. And he said, as I said, foresaw no recession. With Bitcoin at 18,000 a couple of years ago, I asked if it was dead and gone, and he quoted the late, great Charlie Munger calling it rat poison. So I want to hear some comment this year. Last year, John said he'd be all in on domestic equities, holding very little cash, and he warned about a bubble bursting in China, which also happened. So, John, what will we see for 2024?
Thank you very much for that very, very, very kind introduction. This business is the most humbling business in the world, and so it's nice when sometimes it goes right, but you realize the tough times are always right around the corner. We've learned that over these last 41 years. We've been friends for over 40 years. Terry's just been always extraordinarily great to work with and so thoughtful and such a leader in financial education, and it's just great to be here. And I really appreciate the support from last year from Bob and Diane. It's just, we feel like we're part of a little special family. It's great to be here. So what I wanted to talk a little bit today, my basic thesis is to talk about the fact that I think, I always have believed over these 41 years in small and mid-cap value stocks, as Terry mentioned. And I especially want to make the case today that it's a great time for small value and that large cap growth stocks are very, very expensive. The backdrop of that, of course, is this extraordinary time in our country's history. It's probably the scariest time that I've had in my professional life. You turn on the news, you're just nervous, you're just worried, you don't know what's going to happen next. And we all have experienced the stresses of the 2 wars we're involved in, all the international tension going on around the globe, a worry that maybe we'll become an isolationist country and won't be able to grow the way we had all dreamed we would be. And then to have our American society so divided is something that I've never imagined. And the fact that you don't even know what facts to rely on any longer. You watch one newscast, another newscast, you never know what to believe, and everyone focuses on something completely different. It's not like the good old days when you could watch Walter Cronkite on the evening news and know that you're pretty much being told the truth. At least you sort of felt that way. And you don't feel that way today. And the lack of trust in our political system and our leaders is really troubling. And as many people mentioned, our capitalist democracy is going to be on the ballot this November in this exceedingly troubled time. I could go on and on and on. But I also do believe that our capitalist democracy is the best system ever invented. And as Terry mentioned, Warren Buffett reminds us of that every year at the annual meeting, how ultimately America prevails. And I still believe that and still have that optimism that things will be great again after all the things that we've been through in this most recent period. So we still believe in our long-term approach. Our turtle logo is 41 years old also. We're one of the rare investment firms with a tortoise as a logo. Merrill Lynch has a bull, and T. Rowe Price has a ram, and Dreyfus had a lion, and we have the little turtle. Reminding people that Aesop was right, that slow and steady wins the race, and that the tortoise really does beat the hare in the end. But let's just move on to some of the facts and focus on why I think it's an opportune time for small value versus large cap growth. According to JP Morgan, large cap growth stocks are simply just very, very expensive on a historical basis. And we all know that the Magnificent Seven has led the charge, going up 87% last year. And I think everybody knows those Magnificent Seven are Apple, Alphabet, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla. Those are the companies that have been driving the market, making up over 30% of the S&P and driving this great performance. But when you look at the data from JP Morgan, you look at the 20-year average PE for large cap growth stocks are 18.9 times earnings versus 26.5 today. Really at a very, very high level. You look at small cap value stocks over their average 20-year PE, and the average PE for small value is 16.7, and at the current time it's 16.3. So large cap growth 26.5 today versus small cap value 16.3. The total market cap of the Magnificent Seven is right now 3 times the size of every single stock in the Russell 2000 index put together. Just extraordinary. Now, the last time the valuation gap was this large was during the 1990 dot-com era that Terry also touched on. And as you can all remember how that it all ended, that the internet stocks that were booming and booming in the late 90s and early 2000 came to a very, very difficult end when the bubble finally burst. And we know that that was just an extraordinary time. The similarities are, I think, clear. Back then it was all about the internet, and all these companies were all about .com. Now AI is the hottest thing in the world, and if companies are involved and engaged in AI, their stocks could just explode upward. And so we think it's going to end in the same way. You're going to have that same kind of implosion during this environment. Now, if you go back to the year 2000, just to give you the kind of delta that can happen, remind some of you of this, the Russell 2000 Value Index was up 22.8% in the year 2000 as the internet bubble was bursting, while the S&P 500 was down 9%. That's a really large gap between 22.8 and 9. So overall, I think that these neglected, unloved, misunderstood small value stocks are really poised to start a sustained comeback. As we've been talking to our management teams in this sector, every quarter at Ariel we talk to all the companies we invest in, and the management teams have been exceedingly optimistic. After a very tough summer of '83 and a lot of disappointing earnings, lots of disappointments in general, people are really saying 2024 is going to be their year. And the analyst community out there on the sell side is just not really doing their job. The analysts in small value stocks now, their research is a mile wide and an inch deep. Many companies are not being followed at all. If they're being followed, then they really don't have the in-depth kind of research that we were used to years and years ago. And today, the average small value stock has about seven analysts covering it versus large cap growth stocks that have typically 47 analysts covering it. So as these earnings come through better than ever as we move into 2024, I think it's going to be an extraordinary year. And so I think large cap growth stocks will be down somewhere between 12 and 15% this year. So very, very negative after the kind of environment. But you wouldn't be surprised that we think small value will have a really extraordinary rebound and be up over 10% in this environment. During a period where everyone doesn't believe in them, it's going to be a great time to own these types of names in 2024. So really enjoyed the chance to be here. Look forward to the questions.
Don't go. Okay, the gap, that was interesting. I don't think many people remember back to a time when the S&P was down significantly into negative territory. And small cap or value, what was the category you said was up over 16%?
The small cap value index in the year 2000 was up 22.8% versus the S&P down 9%. So pretty extraordinary gap, and people sort of forget that kind of gap can actually exist.
Yeah, that really stood out to me. So do you want to talk about the Dow at year end? It's from 37.5 today.
I think the Dow will do better than the S&P. It's not as chock-a-block with the Magnificent Seven and the high stocks there. So I would say down 10% for the Dow.
Down 10% for the Dow.
Yes.
But what do you think the value stocks index could be? Did you just say up?
I think small value can be up, we think, as much as 10%.
Okay,
And large value be up closer to 5%.
Okay. What do you think is going to happen to interest rates? The 10 year's at 4% right now. Where do you see the 10-year ending the year?
We would say it'd be closer to 3%.
Oh, right. Okay. But when do you think, so that implies, let me ask you first, will it be down because the Fed cuts or down because the economy slows?
It'll be down because the Fed cuts. I think we think the Fed really is on their game. They're doing the right thing in a systematic way. And so we're very optimistic that they have the money supply under control, and ultimately it's going to cause the interest rates to continue to decline.
When do you think they will start cutting, and how many cuts? Can you want to look in your crystal ball?
We would think would start this summer, and it'd be three cuts.
Okay. So is recession in your cards then?
To your question, I think it's a less than 10% chance we'll have a recession. I start to worry as we get closer and closer to 25 that it's been a long time since we've had a real recession of any magnitude. But for 2024, very low odds of a recession.
Okay, and inflation, so the magic number is 2%. And we're over 3% now, 3.5 maybe.
We think inflation will be 2.5%. It'll get to that level, maybe a little lower.
Okay. Here's your chance. Now, Bitcoin's been up, it's been down, it's been all around the town. Do you even still look at Bitcoin? I mean, it's making headlines. It came back. It's over, 47,000 now? It was 19,000. You want to talk about it as a thing? Or isn't it still not a thing to you?
It's still not a thing to me, I think. I think Charlie Munger's made it clear, calling it rat poison. I do think, as you mentioned, and Warren is just not a believer in assets that don't actually produce anything. You know, you want to own a farm that grows corn or wheat or what have you, or have a manufacturer that creates products and what have you. Nothing's produced by Bitcoin. It's all, price is always just based on what others will pay for it. And those things always seem to end very, very badly. And I'm still believing it'll end very, very, very badly.
Okay. And your $100,000, well, now, actually, frankly, let me start out. We didn't know this last year at this moment, but you now have $200,000 because you have your $100,000 and Diane's $100,000 to invest. And we always say it's not your college fund, it's not your, it's not to pay off your credit cards, this is risk investment. So are you going to put it all in the Ariel fund?
Well, I'd love to say to put it all in the Ariel fund, but that would not be appropriate.
Well, it might be. Well, then, Diane, you're going to do it on your own, all right?
Yeah. So clearly, that's where most of my money is. So I can answer it that way. and my family's money, my daughter's, et cetera. But I would say that unusually, I usually try to talk about Chicago stocks because I love so many of the great companies here that we own stock in. Stericycle, JLL, Northern Trust, just wonderful, wonderful companies. But I decided there's one company that I love a lot that I think you could put $100,000 in and own it for the next 30, 40, 50 years. Just don't worry about it. Have it for your kids or your grandkids. And it has a Chicago connection. You wouldn't expect, but it's Madison Square Garden Entertainment. They own the Chicago Theater, which of course has been very successful forever. But they're really well known, of course, for Madison Square Garden, the iconic arena that's the world's greatest arena. And as Warren always tells you, you want to buy a company where it's got a real moat around it, where it's going to be hard for a new competitor to come in. It'll be very difficult to someone to come into Manhattan and build an arena that's going to compete with Madison Square Garden. We think it's pretty extraordinary. It also owns the Radio City Music Hall. So I didn't go to Taylor Swift with my daughter this year, but we went to Radio City Music Hall and saw the Rockettes and the Christmas Spectacular. Sometimes when you're doing your research, you can also have some fun too. And Radio City Music generates an enormous amount of cash. It's a wonderful business. They also own the Beacon Theater, and the sides parts that are going to be really helpful with gaming coming more and more, being able to benefit from gaming revenues in the Garden and in Penn Station. And the real icing on the cake, if you're owning this for 30, 40, 50 years, eventually Penn Station is going to be renovated, and they own so much land right around Penn Station. They have the air rights above it. It'll be a really great boon for Madison Square Garden once that renovation actually happens. So that's been my favorite stock.
I love it.
fund.
Do you own that in the fund?
We do.
Okay. What's the price level right now? Save me from having to go back and look it up next year. More or less.
Oh, it's more or less 32 and a half.
Okay. And does it pay a dividend? See, I'm old. I want to know if it pays a dividend.
No.
Doesn't pay a dividend with all that cash flow?
I don't. They've been using a lot of the cash flow to, it's tricky. Jim Dolan, there's a Jim Dolan discount, for many of you know that name, who controls the company. They also own Madison Square Garden Sports, that owns the Knicks and the Rangers, and they own the Sphere that's been built in Las Vegas, and is doing interesting things. So they've been moving a lot of their cash assets to make sure that it supports the Sphere. And but over time, the cash flow is going to be just bigger and bigger than anticipated. Stock buybacks at Madison Square Garden Entertainment are already in the works. So
We never get great recommendations. I mean, specific recommendations. We get a lot of great ones, but never specific. Thank you, John Rogers.
Thank you.
Appreciate that. Okay, Dr. Bob. By the way, we are going to try and get questions in. So, after Dr. Bob speaks, will you please remember now to text exec, E-X-E-Z, to 22333 to submit. All right, Dr. Bob, it's a highlight of every year's forecast luncheon because his forecasts are so bold and oftentimes extreme, witty, and compelling. As I mentioned, he's introduced us to new stuff, everything from esports a few years ago, the underwear index, who could forget that, and last year, ChatGPT. Again, I'm going to skip over Dr. Bob's incredible long history of chairing investment committees, writing books, and being on boards of mutual fund companies. But I want to put in a plug. He's also the owner of the Kane County Cougars minor league baseball team. He did a masterful job of bringing that organization through the recession this past year. And now they're going and growing again. They're one of the top philanthropic organizations in all of minor league baseball. I read this and I had to put it in. In the top 5% of charitable giving, it has donated at least $1 million a year to charity over each of the past 7 years. He is good and he does good. And here's what you can do to support the Kane County Cougars. It's a gorgeous ball field. I've been out there. We've been out there. The club went out there years ago. It's even better now. Set up group events outside for your employees. Who do they call, Dr. Bob? Call Dr. Bob. Okay. Now, I must say, however, we are still awaiting the market to reach Dr. Bob's Dow 41,000 forecast made 2 years ago. However, last year, when everybody was hemming and hawing, Dr. Bob boldly stepped out and gave a 2023 year-end forecast of 39,000. We're only about 1,500 away. And if you'll remember, so many of you were bears, so I thought that was incredible. And of course, we've mentioned you gave your $100,000 to John last year. Don't do that again. We want to know what you're buying, Dr. Bob.
Thank you, Terry, very much. John, thank you for my new suit. It was awesome. Did a great job last year. But I think one of the biggest mistakes we make as investors is we focus so much on the short term. We want to make money today. We want to make money this week, this month. We don't worry about making money, as John astutely points out, over the next 5 years, 10 years. It's boring, but long-term investing is so critical, and focusing on those issues is so important. And it doesn't mean that we still don't focus on the short-term stuff. I mean, the next economic release that comes out, oh my gosh, we think the world's going to end, or it's going to be the greatest thing ever, and the market's either going to go up or either go down, and then a month from now, no one can even remember what the number was and why we even cared about the number, because it really doesn't matter. It's the long-term investment things that, as an investor, that you really should focus on. And in my perspective, I think there's 3 really important issues out there that aren't garnering nearly as much attention as they should for us as investors. And those 3 issues are robots, water, and China. And let me quickly touch on each of those, starting with robots. And I use the broader term of robots inclusive of artificial intelligence. And I think this has exploded even faster than I thought it would. And it's not going to stop, and it's not going to slow down. And I don't care if you want to embrace it or not, it's going to happen. And so you better get with it, not just in your daily life, but in your investments as well. Just as, think about it this way, just as digital technology changed the world forever, so will AI and robots. You can't stop it. I mean, think about digital technology. If you go back a little over a decade ago, only 10% of the people had smartphones. 10% of the people, and they were on 3G, by the way. Okay? Currently, 85% of this country is on a smartphone, and it's on a 5G network. You can't stop that. That's exactly what's going to happen with robotics and AI. Oh, that same time period, a little over a decade ago, 50% of the people in this country actually had a newspaper delivered to their home. Today, that number's a little less than 10%. And final frame of reference for you for this digital technology explosion, that's going to be the same explosion that we have in robotics and AI, is that a little over a decade ago, there were 1 billion, with a B, 1 billion social media accounts. Today, we're approaching 15 billion. It has changed the world. It's not going back. You can't stop it. You can't even slow it down. And the exact same thing is right in front of you with robotics and artificial intelligence. I'd urge you to think of it this way. With artificial intelligence and robotics, it didn't stay out too late last night celebrating the Michigan victory and didn't show up for work, okay? It doesn't sleep, okay? It doesn't take a lunch break. Oh, by the way, it doesn't ask its supervisor how many days it gets to work from home next month. So it is clearly here to stay. I would urge you, clearly look at robotics and artificial intelligence. The second issue is water. And I would reflect back to maybe one of the most famous lines in movies, in the movie The Graduate, when they quipped, "I have just one word for you, plastics," okay? If we did a remake of that movie today, the one word would change from plastics to water. It's the most needed resource we have, yet one of the most neglected resources we have. Think about why we neglect it. It's because 71% of the earth is covered in water, yet only 0.5% of that water can be used for human consumption, animal consumption, or plants. It's the biggest crisis we're facing, and basically no one's focusing on it. Think about it where we are today. What's causing that focus? Well, it's the growth of populations, it's pollution, and it's climate change. Does anyone think any of those are going to slow down anytime soon? Population growth, pollution, and climate change. It's all coming together, creating this perfect storm of this issue with water. The World Health Organization currently says that 1 billion people on Earth don't have access to water. And another 2 billion people over the next 12 months will have 30 days upon which that they will not have access to water when they want it. And within 4 years, half of the world's population will have restricted water use at some point in time over the course of that 12-month period. It is the single most important big-term issue that we're looking at, and it's also maybe one of the single most neglected issues that we're looking at. So that's the second issue. So first, robotics and artificial intelligence. Second is water. And third is China. I'll give you a quote to think about China. Maybe one of the most famous bank robbers, notorious bank robbers, was a guy by the name of Willie Sutton. And when he was interviewed, they said, so why do you rob banks? And he said, because that's where the money is. And if we would extrapolate that theory into investing, I would say always have an eye on where the people are. Always have a focus on where the people are. Because watch what happens. Where the people are ends up being where the jobs are. And where the jobs are usually ends up where the economic growth is. And where the economic growth is usually ends up being what attracts the investment. And whatever attracts the investment usually moves the markets. So it's really, really important to focus on where all those people are, especially after John so correctly predicted China's bubble was going to collapse. Now may be the single best time to looking at investing there because of the magnitude of the people that are there. Let me give you a frame of reference so you clearly understand the magnitude of this is unprecedented on the face of the earth. So we have one of the greatest cities, if not the greatest city in the United States, in Chicago, okay? We've got 2.6 million people live in the Chicago area, okay? Now, we're so big and we're so important that our population is actually larger than the populations of some entire states, okay? I'm gonna do a little survey like Terry did with you, because she's so good at that. So how many of you think that the city of Chicago's population is larger than at least 5 states? If you think that, raise your hand. Okay, keep your hand up if you think our population is larger than 10 states. If you don't think it's 10, put your hand down. How many think we're larger than 15 states? Keep your hands up. Yeah, that's a pretty smart group. Yeah, 15 states. The city of Chicago's population is larger than 15. We're a dang big deal. Now, let me change the frame of reference to China so you understand why I'm so bullish on this. So, raise your hand if you think China has at least 5 cities bigger than Chicago at 2.6 million. How many think they have 5? Okay, keep it up if you think they have 10 cities bigger than Chicago. Wow. Keep it up if you think they have 20 cities bigger than Chicago. How about 30? How about 40? How about 45? There are 47 cities in China that have more than 2.6 million people in them, and you don't want to invest there because they had a bubble last year. Keep in mind, we invest looking forward, not looking backward. At the end of the day, follow the people. They create the jobs. They create the economic growth. They create the investment, which ultimately creates the investment return. Let me end where I began. A lot of little stuff going on, a lot of things that are going to drive the market up and down, but as a long-term investor, I would urge you, take a look at robotics, artificial intelligence, take a look at water, take a look at China. Those are three great long-term investment themes.
Don't move. Don't move, because we're nearing the end. I promise I'm going to get a couple questions in. I promise. And we won't be sorry if you have to get up and walk out, but we got these people together here. So, Dow, at the year end. Please, I can't wait to hear this.
No, you know this is the Chinese Year of the Dragon. Did you know that?
No, well, no.
Well, you should. It's important. You got to
The Chinese Year of the Dragon.
And why that's important is because it is the most powerful and the luckiest of the Chinese zodiac. So
Okay.
it means we're going to have a really, really good year. And by the way, the lucky numbers of the Year of the Dragon are 1, 6, and 7. So if you extrapolate that to 16.7% of the Dow at 38,000, it puts it at 44,000.
Whoa. Dow?
It'll be 44,000.
Dow, 44,000.
And I didn't forecast 41,000, just so you know. It was 401k, so it was 40,100. But that's only 900 points. But yeah, 44,000.
I remember that. Credit where it was due 2 years ago.
okay.
Dow, 44,000. Just show of hands. Could he possibly be right? Could the Dow hit 44,000? How many people are true believers in Bob? No one. Oh, one. Okay, Joan Steele.
Now look at. Now here's the good thing. Look at Margaret over there. She has the biggest smile on her face because the Executive Club is going to be right next year. Either John is going to be first on that dang screen or I'm going to be first. But Margaret is just smiling because this is exactly what she needed.
Okay, Bob, where will the 10-year Treasury, now 4%, end the year?
You know,
Or go during the year?
3.5, 3.4,
How many rate cuts?
8.
Are you kidding?
No, I'm not. These are real questions. They just,
Yeah.
Yeah.
It's the answers
No,
I'm questioning, not the questions.
Yes, 8.
Okay, so how soon could they start?
First quarter.
First quarter.
First
okay.
quarter.
Will we have a recession next year?
No. No, we didn't have one last year.
Well, are we due one?
No.
Okay, I'm just asking. How low will inflation get?
Oh, you know, I think the reason we're going to continue to cut rates is I don't think inflation is going to go under 3%. So I'd still see it at, 3.3, 3.4, which is why they're going to continue to cut rates.
Okay, now one more thing. I'm not skipping over Bitcoin. That's not your most valuable contribution. Where are you putting your $100,000?
I'm going to put it where my long-term investment themes are. I would take 25,000 of it, and I would invest in, robotics, artificial intelligence. There's a couple ETFs out there that focus on robotics and artificial intelligence. I'm not going to name them. They're not a sponsor. I'm not going to promote them. I'll promote our ballpark, beautiful Northwestern Medicine Field. They're a sponsor, but I'm not going to promote a fund that doesn't even sponsor us.
What else?
And then I put 25,000 then in water. And again, there are a lot of good ETFs that are water resource funds. And then the final 50,000 I would put in small cap China fund. Matthews has a really good fund. I think John really greatly articulated the issue, not just in the United States, but the issue globally about how these orphan small cap companies just aren't being followed out there. And I think there's great opportunity around the globe, great opportunity in China. So I'd put 50,000 in small cap China fund.
All right, now come to your seat for one more minute. A lot of people want to hear these questions. Quietly, if you must. Thank you. A round of applause for our panelists. Now, with due respect for the people that have to sneak out, we're going to get some of these questions in, okay? And I'm going to start with this. Someone asked about the CPI and whether the inflation forecasts are accurate. There's so many different CPIs, all consumers, blah, 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 revised and everything. Diane, please, a little of that.
So first of all, there's a lot of different inflation indicators. The CPI is a weighted basket of goods. It does not change with our spending behaviors. The personal consumption expenditure index, which is what the Fed targets, is actually a weighted average of how we shift our spending over time.
So is it any of it correct?
It's as close as we can get, which means you got to look at everything. It's not that they're falsifying the data. They just made a major correction in how they were counting healthcare insurance costs, and that went from a 39% decline on a year-over-year basis to now it's going to be adding to CPI because it's wrong.
So it's debatable. Okay. John.
They do their best. I'm on
Okay.
the advisory committee for the statistical agencies. I work with the Bureau of Economic Analysis. It is amazing what these people, when you bring up something in a meeting, they will go back and try to fix whatever it is.
Okay.
It
But then
is-
that's hard to compare from time to time. John, I'm going to
No,
move quickly.
they give you comparisons too.
All right, fast
No, it's
round.
not. It's
Wait,
not
wait,
hard.
wait,
I'm
wait,
not-
wait.
I'm going to push back on the facts here. The facts on the data
I
is
defer
they
to
do
you.
the best they can, and they give you the comparison before they revise it and after.
Okay. John, someone said, you talked about small business being the growth area. And today, or yesterday, whatever this is, a National Federation of Independent Business reported its sentiment, which is up a little bit, but still down for many months. Are you concerned about business sentiment out there, small business, NFIB?
It is worrisome. I think you're seeing most of the weakness in sort of the softer parts of the economy are in the smaller businesses. I think that's actually right. I've been chairing the SBA's Council on Underserved Communities and learning a lot about, the challenges of very, very small business in this economic time. And I would just say that having to compete technologically, the things that Dr. Bob's talked about, how important AI is. If you're the little guys, it's just hard when you can't afford to have all the world-class technology to compete with the bigger guys. I think it's really, really hard.
Okay.
Terry, can I
Now,
add something real fast
sure.
to what John said as a small business owner of the baseball team? The important thing is where we are currently is you want to have already made that investment in technology because those companies that have already made that investment, they're doing okay. And if you have a clean balance sheet, which means if you haven't over-leveraged yourself, it doesn't matter that rates have risen because you have a clean balance sheet. So those few companies that we see doing really well are the ones that have already made that spend on technology and are leveraging off of that and don't have a levered up balance sheet that are trying to that have to pay down all that high price debt.
Got to be ahead of the curve. Now, here's one. I wasn't going to ask this. Thank you for whoever sent this in. It has to do with the presidential election, but the economy in the presidential election. And the wording of it runs like this. What impact do you think the presidential election will have on the economy? But I think what you're trying to say is there a difference maybe between who gets elected and what happens to the economy? I realize this is treacherous territory, but we're all Americans, we're all voters. And John, I'll start with you and run right down the line.
Clearly, there would be a major impact on who wins. And I think the wild card is today I was watching Good Morning America, and they were saying that Nikki Haley is within 7 points of former President Trump in New Hampshire. And that's something that I think being a contrarian, it would change the dynamics of this campaign if she was to be able to prevail. It wouldn't have quite the stark contrast that you'll have otherwise.
And go one step further. What does that mean?
Well, it means you would have a much more, I think, honest kind of campaign where people can disagree without being so disagreeable, look at facts, compare facts, carry discussions, and not have the kind of manufactured world that we've lived through the Trump era.
Okay. Diane, the impact, you referred to it a little bit, but one more sentence on the presidential election.
The real issue right now is how much uncertainty there is, and if we were to have, depending on how the presidential election comes out, and I'm being very careful how I say this, when you can change regulation and trade policy with the sign of an executive order, that is a very uncertain time, and that can change our economic situation very rapidly to be much more insular much less global, and makes a big difference for how big companies and small companies have to navigate the world.
Okay.
And I think that's really important to understand.
Dr. Bob, insights on the presidential election.
Look, I think that the impact is going to be more on winners and losers within certain industries and certain sectors. I think what's going to drive the economy in this presidential election year is not who ends up getting in the White House. I wish there was a multiple choice question and I could vote for none of the above, but we can't do that. But I think the issue is going to be, are there 6 or 8 rate cuts? Are people going to buy cars again? Are people going to sell their homes? Are they going to buy their homes? Because quite frankly, no one's been buying automobiles, no one's been buying homes, no one's been selling homes. And if you get rate cuts, all of a sudden the trajectory of that, I think, will be more important in my mind than it will be who's end up sitting in the White House. Now, I don't want to downplay that because I think Diane and John both articulately, it could change policy, but to me, that's more what sectors or what industries you want to be in or not want to be in. I've been in this a long time. We've had good presidents, we've had bad presidents, we've had crazy presidents, and the market has gone up sometimes, down sometimes, and sideways. I think there's more to it. It's not just as simple as saying, oh, there's a Republican or a Democrat or something. It's really, to me, more about the economy and about the strength of what's going on with businesses than it is about what's the individual we put in the White House.
What a way to end this. Thank you to our panelists. Thank you to all of you. It's a big year. Come back next year, and in between, please vote. Thank you.